Moody's downgrades the credit ratings of 9 European countries and smacks France and the UK with a negative outlook. Apple closes above the $500 level and futures are jumpy. I'm Alix Steel and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Alix Steel with theStreet, and together we bring you the morning call. Happy Valentine's Day, everybody. We have stocks really looking for some love here, right? I mean, we had futures very, very choppy. Seems to be taking the European downgrade by Moody's in stride. Is that a positive sign?
I think so. I think once you get certain headlines out of the way and you know how the market's going to react to them, it's always a positive sign. And when Moody's came out yesterday, I know the futures are a little weaker, and then the Bank of Japan with their news kind of, gave them some traction to the upside. So we've been really just bouncing around here, but I think the most important thing here is that the trend's still intact. We're still following the right moving averages. You're still seeing some sector rotation. The stock selection has been a little bit more narrow, and the volume's been a little bit lighter, but it's not a perfect world. This is the new normal. So just stay with it based on your risk parameters. And I think that we take out those highs maybe this week.
I wanted to actually mention something. I read a research note yesterday that said, as of February 10th, the S&P front month option contracts have a large call imbalance. And when that happens, it produces positive returns for the week during expiration, which is coming up on Friday. So I wonder if that's really going to give it the juice to sort of fake it out and get to that 1370 level.
That could be helpful, especially if they want to get it above 1350. Sometimes what they do is they run it through major strikes. So this way everyone gets excited, everyone buys the calls, and then they pull it back to the strike. So this way the option dealers win across the board. So if you look at the chart of the S&P, you'll see that the market's just been trending. And as I've said before, here's your gradual trend. Here's our low that was in October. The higher low in November, another higher low in December. And this gradual trend hasn't been even tested. So if you're a macro investor, you're feeling good. You haven't even, had a gut check. If you're a momentum investor, with this, more accelerated uptrend, you've had a few times where you had to worry on whether or not this would hold. If you recall, about 2 weeks ago, market tried to close below this 10-day moving average, but it couldn't, and then we resumed. And then on Friday, with the news out of Greece, it tested the 10-day again and closed off those lows. So we're taking this market in stride. All the news that's coming out is being absorbed. And now, if we could get and close above this, what is this, 1254? You take a big macro look here, and then that's your 1370. This was the day we killed Osama bin Laden last year. Those highs are in our grasps.
Now, but when you see headlines like the strongest start to the S&P for the year since 1991, that produces two things. You get the people in there saying we are way overbought, we got to sell here, and then those with cash on the sidelines that need to jump in to continue. Would you be putting on some hedges, though, just in case, or keep on your hedges?
As a trader, I've been trying to hold multiple positions, and at different stages of the market, there's better setups. And right now isn't the best setup to be all in long, but you could hold your macro winners, you could add to cash flow positions like we did, a few different sets the last few days, and you keep hedges on just in case you get a day like Friday, where you don't just get blasted. You could actually cover some shorts, you could buy some stronger longs, and you can maneuver your portfolio so you feel better as this market progresses and as time elapses.
And so let's see where some of that strength might be, say, in retail. We have January retail sales coming out at 8:30 a.m., so we wanted to highlight some of the big names to see where some support, resistance might be and how you can trade around them. Want to start with Walmart. Now, same-store sales for January showed a 4.2% growth, right? But Walmart's not included in that, but that was still way above expectations of 2%. But is the good news still already baked into Walmart's chart?
Well, on the last thing you said about whether we're overbought and the best start since '91, this is a perfect example because Walmart has been in a 10-year base, 3,000 days of pain if you've been sitting in Walmart in this range. So if you look right here quickly, first I'll go to the monthly chart of Walmart to show you what I'm talking about. This is my stock of the year because look at this. Since 1999, the stock has done absolutely nothing. So, at this particular point, finally, it's getting above this upper end of the range. We talked about 58, 59. So on this chart, it doesn't look extended at all. It looks like, it could probably get to 70, 75. But then when you go to the daily chart, that's why you have to know your time frame, it looks like it's had a hell of a move. And at this particular point, I'm still long it. I'm going to try and stay long this as long as the uptrend stays intact. If this starts getting above 62, you could see another move here in Walmart. And here's your line in the sand, which is about 59.89 for those momentum players.
Now, earnings are coming out next week, actually. So would you also be maybe taking the opportunity to tier out if you see the momentum kind of tiring out, but keeping that core position?
If you're a macro investor and you hold through earnings, stay in it because you won't get back in it. If you're a trader, and I tend to 90% of the time not take stock into earnings, I take in the money calls because that's what I do. I'm a bit risk averse, and I could wait for the numbers to come out and trade it after hours. So you have to know your availability and your capabilities. For Walmart, if you plan to hold on to it for the year, I wouldn't be in a tier 2 or tier 3 into the earnings, but be in a tier 1, stay the course, because I do think Walmart has higher prices.
Let's go to Under Armour. The stock really delivered a good quarter back in January, right? It was 62 cents a share, net revenue of over $400 million. That was due to a 27% increase in apparel net revenue. We also had footwear net revenue up over 40%, which was huge. But they did guide lower revenue growth to be the lower end of their previously estimated range. That was kind of like a little murky there. But also you have Nike doing really well. And you wonder, maybe, is Nike a better bet than Under Armour?
Well, I think they could both exist. And Nike's been a stellar performer this year. Under Armour has been a little choppy, like you said. But look at the pattern here. I like it. I'm not in Under Armour, but I might do, a casual type trade. It's come off the lows. It's above all these moving averages. You have a nice tight flag here. If it could start getting above this 82.50, I'll probably take it for a cute trade. And then if it starts getting above 85, this stock could be at new highs. So if you're an investor in Under Armour, I would stay there. As a trader, you have a nice tight pattern here above this like 83 area. Let's see if we can get an extension here for Under Armour. And
then what about Lulu? Right at those 52-week highs, is the easy money pretty much over at this point? They don't report till March, but they did issue bullish fourth quarter guidance.
Lulu's been something I've been holding on to now for like 3 weeks, ever since that gap held when they pre-announced. But there's been no momentum, and that's been a problem in February, that the momentum moves, they've been far and few between, except for obviously Apple. So if you look here at Lulu, you have, this was your gap up, which held, which we all talk about that being healthy. I think this was the day that I got involved when it recrossed above this pivot, and it's been like just slowly choppy, and that's why by holding less size it doesn't really matter. I would love to see it trade above this recent high of 66 and finally extend. Let's get some momentum here back in this market, because I know traders like me are getting tired that you can't buy highs and have it go higher. I'm sorry, I'm having a problem with these lines here. There you go. What I'm trying to show you is this is what I want to see with Lulu. I want to see it go. I want to see some momentum. I want to see this thing north of $70. All
right, let's go to Target, because its ex-dividend date was yesterday, so we might see maybe some kind of a sell-off today.
We'll see. I know that Jill was negative on it, and it was a great call a few weeks back, but it seems like it's got a little bit of its mojo back. I know they had a problem going from too much food in their margins, blah, blah, blah. I don't know too much about that, but anyway, on the chart, you could see that it's above the moving averages, which I like to see, right? It's above all of them, showing you accumulation. We'll have to see how it reacts to the being ex-dividend, but you do have a nice tight pattern here also at Target above this above this 53, and then all of a sudden your next resistance 54. I would say guys looking for a trade with tight patterns here, this Target looks like it can get an add-on buy and hit this 54, so it seems like it's acting a bit better from where in December it had that decline. So I would stay with Target for now. It doesn't look faulty.
And then rounding it out here, we wanted to go to Tiffany's, sort of get the high-end luxury, and this is great too because it is a commodity play, it's also a Euro play, and a Wall Street play all wrapped into one, right? So it's well off its 52-week high. Warned in January the company's sales growth for the holidays wasn't going to be that great, like I mentioned, has that exposure to Europe. And I also said, Wall Street bonuses are down, they're not going to go shop at Tiffany's on a total base level.
And the stock's actually showing all those things. Because,
buying opportunity then?
Well, a lot of these bottom feeders or these lower pivots, they've worked as trades. As an investment, it's been somewhat in the penalty box. It's not near highs. You're not happy about it. But as a market timer, you could look at it and say, wow, then maybe there's an opportunity right here. If you look at Tiffany's, you'll see that it's got a downtrend, right? Here's your high, lower high, and here's your bottom and higher lows, and it's getting nice and tight here. If this can get above this 65, 65.50 with some volume, there's no reason why, if these retailers continue, this thing can't run back to the resistance of this moving average around 750, which would be a nice trade from this lower level. So I would say you could buy it, use this 62 area as a stop, and if it starts getting some momentum, you could see a nice percentage winner there with Tiffany.
All right, and speaking about Tiffany, we're going to talk about gold in just a second. Gold and gold stocks, as well as Apple over 500. So stay with us.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
All right, we're back. We're going to talk about gold and the miners. Scott, I wanted to highlight these because we have two biggies coming out later this week. First, on Barrick is coming out on Thursday. We're looking for $1.25 a share. That's 12%. Barrick is also expecting 12% gold production growth over the next 4 to 5 years. Not that great compared to, say, the Gold Corp, which is reporting on Wednesday, which is 70% growth. How are these charts shaping up ahead of the earnings?
So which one do you want to look at first?
Barrick, ABX.
Okay, here you go. ABX, these miners have not been acting great. Okay, they're still trapped. A lot of them are still trapped in these downtrends. If you look here, you will see here's your high, lower high, lower high. As I showed you with retail above moving averages, these are kind of below it. It's going to need some major volume and some good earnings to get above this 50. I have no interest in this stock until it clears 50 and holds it for at least a 30 to 60 minute basis. Otherwise, I would just avoid this one.
Okay, Gold Corp, that's GG, and we're looking for about 60 cents a share.
All right, this one looks even worse. This one, you have your high, lower high. You know, it's just slowly dribbling lower. It's below all the moving averages. You know, there was some excitement right here. Okay, which shows you when they ignite. You want to see if it can.
And that was a 70% growth target that was grown from 60%.
Okay, so that's why the excitement was there. See, the chart always tells a story, and there's a story. So as it comes in, you could see, you know, maybe it could have, if it would have been, I would say, strong, it would have held the top third of this, but now it's below. I guess if you didn't get caught in this, if you're a big believer in this company, which I don't know too much about it, I'd say you could buy it, but I would avoid this one also until it starts getting above these moving averages and clears this 49 area, you know, for some momentum. I'm not going to buy dips in miners. I'd rather wait for some momentum.
And just to point out, though, that Gold Corp disappointed last time because of its Penasquito mine. They missed production on that, but now production's okay. So it's sort of like if they don't mess up,
right,
it might be some kind of catalyst here. Okay, that said, Randgold, however, did report a really good fourth quarter, raised its dividend, and so showed some relative strength yesterday compared to the rest of the miners and gold.
Okay, and this one has been one of the favorites. This is something you've talked about all.
My favorites. I don't know anyone else.
well, you've been you know, you talk about it on dips, and it's for some reason it seems like you have to buy them on dips because momentum's hard to find here. So if you look at the chart here, you will see that as this came back to this old high, all right, it had some resistance, and now some bears will say, oh, look, we have a double top. Here's a top. You know, it kind of opened up here and then hasn't seen an update since. It's not below all the moving averages like I just showed you with the previous one, so this is actually showing some relative strength. Again, for me, I'm going to avoid these things unless there's some momentum. I feel no reason that they always get in trouble. You know, if you want to look for a dip, here is 108, and then here's the uptrend that's been intact, and it seems like a better buy every time it hits, you know, this uptrend to buy it versus buying strength. But if it could hold higher, I guess, if it holds above 110, perhaps it's in the game if gold itself starts to make another move, because right now, you know, people looking at gold are not sure if it's like topping here or going to retest that breakout area of the downtrend from Fed Day. So I think there's a lot of unknowns here. There's safer places to trade right now.
Right. Okay. Let's go to Yamana though, because when we had talked about gold stocks in the past, this was one that actually was holding up. It's AUY. Reports next week did announce its growth targets. We're looking for 60% growth between 2011 and 2014.
All right. Well, this one had an exciting move, and it looked like it was going to try and take out the highs. It was flagging, and then the flag faltered. So if you're looking at a flag pattern, looking for momentum, you know the rules there. If it doesn't stay above that momentum area, you get out of the way. And if you look at the chart here, you will see, you know, this was the exciting day that that people saw, and this was a nice momentum day when it went above 16 for a trade. And then I remember guys talking about it, saying, "Oh, look at this one. AUI is flagging. Perhaps it could get above 18 and continue." You know what? It flagged and it failed. So I would say this is a very important area for this. You know, this is pretty much the lower end of that wide range bar. So if you want to trade it long versus 16, it also is not below all the moving averages. It's above the two. I would say AUI and GOLD are the only two miners right now that I would look at that look somewhat constructive.
And very quickly going to the royalty companies, which we had looked at before, if we go to RGLD to see how that chart's holding up. Solid quarter net income was 42 cents a share. Revenue is up 22%. Both were somewhat light, but also had a lot of growth from a year earlier, but just had a share offering. So I wanted to see how the chart was looking.
This one seems like it did a round trip also. Traders hate round trips. Traders like a one lane up and then sideways and continue. Here it had one lane up, which was hard to grab. So if you look here, maybe a few lanes up. Here was your wide range bar. You had a little bit of follow through, but then, you know, we talk about sometimes ascending trends. Well, here was your ascending little trend that got taken out to the downside with one swift kick to the you know what, and now it's back at support. So maybe, you know, you could buy versus 68 area, but again, none of these miners look that great to me. I'm sorry.
Looking for some love here, not getting any. Okay, talking about one stock that's not making a round trip, Apple. What do you do over 500 now, 507? Do we get that push to 520 like you were calling for yesterday?
I think you have to know your time frame. I know that I've been trading it back and forth the past month. I've been trading my whole career. If you're an investor in Apple, stay the course. Don't look at the stock price. It's still cheap. The PE is low. They make a ton of money. You know, hopefully they finally give a dividend. And I know this is a quick hit, but I love talking about Apple. Sorry.
Split the stock, make it cheaper. There you go.
Well, anyway, a lot of guys were worried about whether they would pin into 500. So it was the right call to say they push it through, make people buy the 520s, the 540s. Then maybe, you know, Wednesday, Thursday, we look for a cute pull-in, but real quickly at the chart here, you will see that this is when we talked about buying it after the earnings gap. You know, and ever since then, it's been a huge move. Yesterday was a nice little trade through 500. I know I caught that early in the morning, you know, and then it held the previous high, and now it's going up. You know, watch yesterday's high as a pivot, 503.83. As long as it stays above that this morning, it can continue. If it comes back below and you're a short-term trader, take some profits, but don't flip short yet.
And Amazon, a good 3 1/4 move yesterday. More room?
Yes, I think you can make another $4 or $5 here. I'm not going to put the chart up. It looks okay to about 195.
And Netflix on the flip side did not do so well. Would you be shorting still here?
I covered my shorts yesterday. I want to show this chart pattern because I love it. I'm a narcissist. Red dog reversal. There it goes. I'm not really. Anyway, with that said, I have a strategy that you all know that I've named called the red dog reversal. When it pushes through an area and fails, sellers take control. This was your short entry as a swing trade. Okay, and then even if you didn't want to take it for a swing, had a 3-day range, it broke yesterday. So that was a nice short money for a lot of guys on my desk. And I do think at some point it could test this earnings gap of about 112. So if you want to stay short, just be careful. This thing is very whippy for me. I'll see where it's opening. If it trades through yesterday's low, I might do a Q trade for cash flow, but I would be covering in front of this gap.
Now Google up 1%. It wasn't obviously like a Netflix, but didn't show as much life as the Amazon and Apples of the world.
It hasn't, but ever since Facebook came out, people are starting to really see that Google is very, very cheap. And I know people give me a hard time that it was my stock of, you know, 2012, but you know what? We're 6 weeks in, and the stock held the 200-day. You know, you could have averaged down. You could have a great price. It was great into this support here. So I know it failed on earnings, but you know what? It's already taken back that earnings gap, so it's no longer in control. I think it can continue higher. I think if you're an investor and you bought the 200-day, stay in your position this year. It will take out these highs as a trader. It's a little choppy in here. Guys aren't having much success, but above 615, if you see volume, maybe it fills the rest of this scenario all the way up to about 630.
All right, very quickly, last stock, totally different sector. Celgene up 2% yesterday. Do you want to lock in some profits here, or is there more trade going on?
I think there could be an add-on buy on Celgene. You know, I read IBD, big cap 20, it was number 2. They're showing you a nice buy area, which I'm looking at also real quickly at the chart. I promise I'll be quick. Above 74 with some volume, perhaps it gets another move. The real buy was right around this 69. I think your add-on buy with this nice base here is above 74.
That was pretty quick, Scott.
Yeah,
good job.
I'm getting better at my old age.
All right, so then what's the one thing you're going to be looking at today? Is it still staying flexible, really looking for the stock rotations?
Yeah, I just want to make sure that things continue. We've not closed below the 10-day moving average since the December 20th gap and go. So as long as that stays the case, you have to stay the course. Some days are better to have risk on, risk off. I know last week a lot of guys were frustrated, including me, because we had those 3 choppy days and we weren't sure whether this upper floor will hold. But the longer we stay above this 10-day moving average, the longer we stay above now 1341 to 1345, the better the probabilities is we push through that 1354 and we go on our way to 1370.
All right, that's good stuff. Happy trading, everybody, and happy Valentine's Day.